Hey, and welcome back to Protect and Invest with Marsha, where I help people become financially free. Today, we're going to talk about mortgage protection. As somebody that connects individuals and families with this particular product or service, I think it's important to kind of talk about what this is because many people don't know what it is. Many people may not even think they need it. Some people know they need it. They just don't know what it is. So hopefully in this video, I can kind of explain to you what mortgage protection is, how it works, and some things you need to be aware of when it comes to this product. So make sure you go ahead, stay tuned, and in the meanwhile, subscribe, comment, and like this channel so we can inform more people and help them get to their financial freedom. All right, the first thing we're going to answer is, what is mortgage protection? So mortgage protection is an insurance that basically will pay off your mortgage if you die. Right? And the point is so that if you do die, your family is not left homeless. They're not left being unable to pay off the mortgage. So it's very important that families, especially married couples, have mortgage protection. Now, if you have, let's say, a life insurance policy, oftentimes people may use their life insurance policy to pay off their mortgage, and that's perfectly fine. Mortgage protection basically is using life insurance to pay off your mortgage anyway. So if you do have a life insurance policy, make sure that if the mortgage is important to you, that there is enough coverage amount in the policy to pay off your mortgage if something happens. A lot of times people are underinsured. Most people need 10 times their income with their policy amount to make sure that if it was ever to be used, if someone passes and you can make that claim and get those monies, you want to make sure you're not surprised and you're not underinsured, okay? You want to make sure you know how much you have for your coverage, and if you need to upgrade it, if you need to get more, you do that now, because life insurance rates are based on two things, okay? It's based on age and health. The older you get, the more expensive it is. The more unhealthy you are, the more expensive it is. And really, life insurance or mortgage protection is supposed to be something that you pull out at a younger age because generally you're oftentimes in better shape anyway, so you'll likely get the lowest rates. That's basically it. So anyway, so with mortgage protection, the way it works is it's structured so that it matches your mortgage, and basically the coverage amount in your life insurance policy will decrease as your mortgage decrease because you're making payments, right? So when you make payments over the next 30 years, for instance, your policy amount will go down with it because the purpose is just to cover the mortgage. Now you may be asking, so how is this different from private mortgage insurance, PMI? So it's different because PMI is often insurance that your mortgage lender is going to require of you when you purchase a home. And they may require it of you if you end up paying less than 20% for your down payment. And they just want to make sure that if something happens to you where you're unable to pay, that insurance kicks in to protect them so that they're not losing money. All right, it's really for them. Whereas mortgage protection insurance, right, MPI is really meant to protect your family. Though they both can protect your family from losing the house, the mortgage protection insurance is really for, hey, I plan on making my payments, but if I die, I want to make sure my family's okay. In addition, your coverage, your mortgage coverage may be able to, depending on the insurance company, cover other things like funeral costs. Maybe you can build into it to cover other home ownership related costs, right? Because maybe there's utility services and all these types of things that for the first year after death, you don't want your family to worry about. So some insurance companies may allow for you to build out more room in your coverage besides just your mortgage so that you can take care of other things. But anyways, that's the main difference. Now, there's a benefit to mortgage protection that I like compared to term insurance, for example. One, it's very specific, right? So mortgage protection is really just meant for your mortgage. And the way it is that when it kicks in, basically the insurance company will send a check straight to your mortgage lender to pay off your house. Great, good, wonderful. And it oftentimes is less expensive than your regular term life policy or term life insurance policy. Now, why am I bringing up term life insurance? Well, oftentimes mortgage protection insurance is a decreasing term life policy. And the way that term life policy works, similar to mortgage protection insurance, is that you take out a coverage amount for a period of time. It can be 20, 25, 30 years, right? And basically it matches the term on your mortgage. So your mortgage may be 30 years, for instance, but a term policy is meant to just cover a period of time that in the event you pass away, make a claim, coverage comes in, right? And most insurance work on a term basis anyway, like car insurance, health insurance, right? You have to constantly renew your car insurance. You have to constantly renew maybe your home insurance, your health insurance. You pay premiums to cover you for a period of time until renewal is up. The same thing happens with term insurance, okay? But really the way life insurance is meant to be seen compared to other insurance products is it's really meant for you to have protection during the most vulnerable years of your life as you become an adult, grow into your career, and become financially stable, and to where you wouldn't need life insurance anymore. That's really how it's supposed to be seen. It's like this net, this safety net that if crap hits the fan and I pass away, my family will still be okay. They'll get a huge check to take care of them and hopefully help them build wealth. Or you can outlive that policy or be able to become financially stable to where you don't need that policy anymore. So it's important for you to understand how life insurance is really supposed to be seen. It's not supposed to be life support for the rest of your life. You're supposed to see it as a tool to get you to financial freedom. That's really what it's supposed to be. It's supposed to be temporary help, not lifelong, like whole or universal life, which I've talked about in my previous video. Now, here's something you should know that may be a drawback when it comes to mortgage protection, and it really depends, I think, on your insurance company. So generally speaking, mortgage protection may not cover, home ownership related costs. I know earlier I said it could. Again, it depends on the company and how the policy is written, but generally speaking, it may not actually cover those costs as well. It's up to you to know what your insurance policy will and will not allow for before you even get it, right? So they may not be able to cover HOA fees, right? They may not cover the utility costs. They may not cover taxes, right? Like these are other additional costs to owning a home, and mortgage protection is sometimes just strictly that. The insurance company is only going to pay for the mortgage, and that's it. Everything else is on you. And for some people, that's a good thing. Like, hey, maybe that's all they needed. Maybe that's all your family need is cover the mortgage. Everything else I can handle. Great, wonderful. If that's not you, then you need more than that. And if for whatever reason it's not working out for you, or you realize you may want to be able to build out more in the amount, you can do that. Maybe you have to just consider a regular term life insurance policy. Yep, you're probably paying a bit more because the coverage amount is available to you for the next 20, 25, 30 years, whatever your term is. And you can use that money towards your beneficiaries and their costs of living and their education, and making sure it's money that they can use for whatever is of importance to them after you pass away. So it's really up to you to know what your objectives are, and then how these products work, and then determine which one fits your objective. That's really what it's meant for. So yep, that's mortgage protection in a snap. If you know you need it, go ahead and get it. Like I said, I connect people with mortgage protection. If you're interested, definitely give me a DM, a contact. Let me know in the comments if it's something you want to talk about more in detail. But nonetheless, I think it's important that we understand these things, especially as we become adults, or we are adults and we're so busy in life that we don't really know what these things are that are important to us. We may be talking about it, we may be mentioning it, but But you know, it's until tragedy hits and people start realizing, oh crap, we should have done this. And it's not about woulda, shoulda, coulda. You can invent a woulda, shoulda, coulda moment by learning now, making your decisions now, figuring out what you need, figuring out what all this stuff is as you do your research and as it comes up to you or maybe offered to you, so that you can make a swift and informed decision to protect your family. All right, so with that being said, go ahead, like, comment, subscribe to this channel, to this community of people who are growing and learning together. That's what we're all about. You don't have to have it all together to be part of the team, okay? I didn't have it all together, right? And I'm still learning, I'm still growing, I'm still applying things in my own life, okay? I've had to make my own sacrifices, and I'm still heading in the direction that I want to be in. So go ahead, and I will see you on the next video.